Hello options traders, welcome everyone. I wanted to talk a little bit about making a case for vertical spreads. And what prompted me to do this is I was just speaking to a group and many of the traders kind of shot down the idea of vertical spreads for the sole basis that they have limited rewards. And they said in a lot of cases, if we're going to be trading earnings announcements, FDA announcements, unusual option activity, things like this where we're looking for potentially explosive moves, why would we want to limit it with a vertical spread? And because it's limited, we automatically cross it off our list. Well, that's a really limited way of understanding strategies and how to apply them, because we can scale any strategy out to anything that we want. So the first thing to understand, and I talk about this a lot in my videos, is to always remember that no strategy is best. Compare any two strategies, and it's not just with options. You could look at stock and bonds and vertical spreads, doesn't matter. One strategy always outperforms another at various stock prices. But that also means it underperforms for other stock prices. So for instance, let's take a look at a long $100 call here in blue, and in red we've got the 100-105 vertical spread. So both traders do own the $100 call, but we do see some differences in the outcomes. But notice that right here, that the red and blue lines cross. And that's what's called a crossover point. And because there's a crossover point, I immediately know that I can't say that one is better. So yes, these traders were correct that right here we have this small limited little sliver of profit right here on the vertical spread. Whereas in the blue, I have this nice unlimited potential gains. However, take a look at the left side of this vertical dotted line right here. You can see that the red curve, the vertical spread, sits above the blue. So it outperforms the long call. However, if we flip to the right side of the vertical line, the opposite happens. Now the red curve sits below the blue. It underperforms. So again, I can't really say that one strategy is better. And it's the same thing when we're talking about the vertical spread. Be very careful about saying it's a inferior strategy because of this or because it has limited rewards. That's never ever true. Instead, we have to understand how to apply it. So let me give you an example. Let's say that the stock is trading for 100 and we believe it's going to rise to 110. And you buy the $100 call because you want the unlimited gains, in which case the very most that call could be worth is $10. Now that doesn't mean that's going to be your profit. That's going to be determined on the purchase price. But if the stock is 110 at expiration, the most it could be worth is 10. What about the 100-105 vertical? Let's say that I buy that instead. Now my maximum gain is 5, is the difference in those strikes. And that's true, but what if I did the spread 2 times? So now the 100-105 vertical spread times 2 gives me a maximum gain of 10. So now take a look at the maximum gains at expiration. On my vertical spread, it's 10, again based on our assumption that the stock is going to 110. And from your strategy here with the $100 call is also 10. There's no difference in there. But there is another big difference that traders overlook. And that is just because we might think that the stock is going to 110 doesn't mean that it's going to. Let's say that the stock only moves to 105. Well, I still capture the maximum because I only need the stock to go to 105, the strike of that short, to capture that maximum. So now this brings up an interesting point. Think about this. What's more likely? For the stock to run to 105 or for it to go to 110? Okay, it doesn't matter how much you think the stock is going to 110. Market doesn't care what you or I think. Market always does what the market does. But we do have to agree that it's far more likely for the stock to go to 105 than to 110. So right here is the big key. If we at least can see that the stock has a much better chance of hitting 105 than 110, and both strategies can make 10, maybe I would be better off with the vertical spread. So let's go over to an Excel spreadsheet and see how this can play out. All right, so here's an Excel spreadsheet that I created, and it looks a whole lot more complicated than it is. But let me just give you a quick rundown of what we're looking at here. I've got the stock at 100, volatility at 40%, and we've got various days to expiration in this column right here from 30 down to 0. I also have interest rates at 2%. Now in this first block right here, I'm assuming that the stock is at its current price of 100. And what we're looking at in this column right here are various values for the $100 call depending on the time to expiration. So if there's 30 days to expiration, that call is worth $465 right here in red. 1 day later, with 29 days to expiration, it's worth $457, and so on. I do exactly the same thing for the 105 call in this column. And over here, I calculate the value of the 100-105 vertical, which is going to be buying the $100 call for $465 and selling the 105 for $266. That gives me a price of $199, or about $2. But if I buy this spread twice, it now gives me a cost of $398 right here in blue. So the first thing to notice is that I've spent almost $4, $398, whereas you have spent $465. So right off the bat, I have an edge here, because if both strategies go bust, I'm only going to lose roughly $4. You're going to be down $465. So I've greatly, or at least sharply, reduced the risk more than what you have done. But now let's assume that the stock jumps to 110, and that's what we're looking at in this block over here. So if the stock is at 110, these would be the various values for the 100 call, various values for the 105 call, depending on when it hits 110. So if it hits 110 today, the very day we buy these strategies, your call is worth $11.50 and my spread's worth $7.14. Now I could also back out the prices that we paid. That would give you a profit of $6.84 and would give me $3.16. So let's take a look at how these profits look on a chart, and I'm going to change these here. I'm going to make this blue, and let's bring it over to the profit for the 100 call, and then let's take the orange one here. That's going to be the profit on the vertical spread. So you can see that yes, the long call outperforms the vertical spread because the blue line sits higher. But that's assuming that the stock price makes an immediate jump. And the reason is that you'll get to keep that extrinsic value. I, on the other hand, with the vertical spread, am going to have a liability with that short option. But as that time passes, that liability shrinks. And so take a look at what's interesting, what's happening here. If we wait for time to pass, your strategy just continues to lose money. And that's because you have negative theta. But look what happens for me. My strategy actually makes money from the passage of time. I've got positive theta. And if we go real close to expiration before this stock hits 110, I'm actually going to outperform you. And again, that's because I paid less for the overall strategy than you did. Now we can also see this maybe a little more clearly if we look at just the values of the $100 call here with the stock at 110. And here is the column here showing the values of my vertical spread. So notice when we don't account for the purchase price, look at this, they both meet at $10. So again, the only advantage that you have is if this stock happens to get here quickly. But if you're also going to make the argument that you're going to be trading earnings, unusual option activity, FDA announcements, things like this that are more of a binary event, the stock price is going to skip right over these anyway. All of that extrinsic value is going out anyway. So you might as well not bank on that as part of your profits. So see, I can exactly match you, but I still get additional benefits. Now, there's a lot of different benefits. The key one that I wanted to highlight in this video is what I mentioned before. Let's assume that the stock doesn't go to 110, but instead goes to 105. Now let's take a look at the profits. There it is with the stock at 105. And here it is with the stock at 105 on my spread. Now look what's happening. Yes, again, the long call by itself in blue will outperform the vertical spread, but only for the first few days, maybe 14, 15 days. And then we hit a crossover point. After that, this vertical spread greatly outperforms the long call. Why? Because if you have one call with the stock at 105, you're heading to a value of 5. I'm heading to a value of 10. And that's what we're seeing over here. Here's the value of the 2-time spread is at 10. And here's the value of your $100 call is just at 5. And again, that's assuming the stock is at 105. So the point to see, this is the graph that tells it all, is that I can set up a strategy, even though it might have limited gains, that is going to outperform yours under certain conditions, and it's also going to give me lower risk. I'm not going to have as much to lose if I'm wrong. Now the trade-off is that you will keep the extrinsic value if this move happens quickly. But again, that's not really the thing that you want to bank on, because if you're looking for speed of movement, then you should be looking at gamma strategies, and that's an entirely different strategy altogether. But hopefully this will help you to understand the idea. The main thing I want you to get from this video is that don't limit a vertical spread just because it has a limited gain. If you think the stock is going up 15 points, fine. I can do 3 $5 vertical spreads and have that same outlook. But I'm still going to outperform you if the stock doesn't quite get that high. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.